We're coming to the end of the year. Maybe you've been saving diligently, investing consistently, cutting unnecessary expenses, and watching your accounts grow bit by bit. As 2025 wraps up and we look ahead to 2026, you're probably reflecting on your financial progress and wondering how to make your money work even harder. That's where compounding steps in as the smartest, quietest superpower in wealth building. It's not about chasing hot tips or risky bets. It's about setting up your money to earn more money on its own, day after day, turning steady habits into exponential growth. In 2026, with the Federal Reserve continuing to ease rates, projecting the federal funds rate around 3 to 3.5% by year-end, and contribution limits rising, this is an ideal time to position yourself for compounding to truly favor you. Today, we'll break down the smartest, straightforward ways to harness compounding in 2026, using simple steps that build real momentum over time. Compounding works like a snowball. Gathering speed down a hill, it starts small with your initial savings and returns. But as interest earns interest, or dividends buy more shares, it picks up size and pace dramatically. The magic happens over years, not months. For example, $10,000 invested at an average 7% annual return grows to about $20,000 in 10 years. But thanks to compounding, it hits over $76,000 in 30 years without adding another dime. In 2026, conditions look supportive. High-yield savings rates are still strong at up to 5.0% APY from banks like Varo as of mid-December 2025, though they may ease slightly with Fed cuts. Stock market outlooks are optimistic too. Analysts from Morgan Stanley to Deutsche Bank project the S&P 500 climbing towards $7,800 to $8,000, driven by AI advancements and solid earnings growth around 14%. The key to making compounding favor you? Start early in the year, add consistently, minimize drags like taxes and fees, and give time a chance to work. The smartest move to kick off 2026 is maxing out tax-advantaged retirement accounts. These let compounding run wild without taxes interrupting the growth. The IRS has increased limits for 2026. Your 401k, 403b, or similar workplace plan allows up to $4,500 in contributions, plus any employer match, which is free money that compounds immediately. If you're 50 or older, add an $8,000 catch-up. For ages 60-63, many plans offer a super catch-up up to $11,250. That's potentially over $32,000 tax-deferred or Roth. IRAs get a bump to $7,500 with a $100 catch-up for those 50+. Roth accounts are powerful here. Contributions are after tax, but all growth and qualified withdrawals are tax-free forever. If eligible for an HSA with a high-deductible health plan, limits rise to $4,400 for self-only or $8,750 for family, plus $1,000 catch-up if 55+. These offer triple tax perks, pre-tax contributions, tax-free growth, and tax-free medical withdrawals. Automate payroll deductions or transfers starting January 1st. Money invested early in 2026 compounds for the full year. Once those are on track, fortify your emergency fund in a high-yield savings account. As of December 2025, top rates hit 5.0% APY, far above inflation and growing your cushion safely. Target 3 to 6 months of expenses, around $20,000 to $40,000 for many households. This fund is crucial because it prevents you from pulling from investments during dips, which breaks the compounding chain and forces sales at low prices. With Fed cuts ongoing, rates might dip to 4 to 4.5% mid-year. So lock in higher yields now if possible, with no penalty CDs or top savings accounts. For long-term growth where compounding shines brightest, focus on the stock market through low-cost index funds. Historically, the S&P 500 has returned about 10% annually over decades, including dividends. In 2026, forecasts suggest continued gains from AI productivity boosts and corporate earnings growth, potentially 10–17% for the index. Diversify with total market or international funds. Emerging markets in Europe could catch up as their economies stabilize. Add bonds for balance. With rates easing, bond prices may rise, offering steady income that reinvests. A simple portfolio, 70–90% stocks. If younger, tilting conservative with age. Use dollar-cost averaging. Invest fixed amounts monthly regardless of market swings. This buys more shares when cheap, less when expensive, and keeps you invested through volatility without emotional timing mistakes. Handle debt wisely to avoid anti-compounding effects. High-interest credit card debt at 20% plus erodes wealth faster than most investments grow. Pay it off first for a guaranteed return. Low-rate debt like mortgages under 5% can stay if your investments outperform after taxes. Refinancing if rates drop further in 2026 could free cash for compounding elsewhere. Cut hidden killers of compounding, fees, and taxes. Choose ETFs or index funds with expense ratios under 0.1%. Over 30 years, low fees can add tens of thousands via extra growth. In taxable accounts, harvest losses to offset gains. Rebalance annually, but avoid frequent trades that trigger short-term taxes. Explore real estate for another compounding layer. REITs in your brokerage provide dividends that reinvest automatically, plus potential appreciation. Easy and liquid. If ready for more, a rental property with leverage lets a down payment control a larger asset. Building equity as rents cover the mortgage and values grow. Protect your setup with insurance, health, life, disability, umbrella, to avoid massive losses that reset your progress. Update estate plans like wills and beneficiaries so wealth passes smoothly. Track everything simply. Use free apps or spreadsheets for net worth, contributions, and returns. Review quarterly, adjust as needed, but stay patient. Compounding accelerates most after 10-15 years. Real stories show this power. Someone maxing a 401k from age 30 at average returns could hit millionaire status by retirement, largely from compounding. In 2026, higher limits and supportive markets give you an edge. Picture your future. Consistent 2026 actions. Maxed accounts, regular investments, low drags, turning today's efforts into financial freedom tomorrow. It's not complicated or flashy. It's disciplined and relentless. Start this week. Boost your 401k percentage, fund your IRA lump sum early, or open that high-yield saver. Make compounding your ally in 2026 and watch it favor you for decades. At this stage, the real advantage is behavioral, not technical. The gap between those who merely reach six figures and those who turn it into lasting wealth is consistency under boredom. There will be years when markets are flat, headlines are noisy, and progress feels invisible. That is precisely when compounding is doing its most important work beneath the surface. By maintaining simple systems, automatic contributions, periodic rebalancing, and a refusal to react emotionally, you allow time and mathematics to do what effort alone cannot. Wealth at this level is not built by intensity, it is built by endurance. Start today. Raise that 401k contribution, fund your IRA early, or scout high-yield options. Make compounding your strongest ally in 2026, and decades from now, you'll look back grateful for these simple choices. Thanks for watching. Take one action this week, and your future self is already smiling.